You know, most investors, we obsess over one thing, right? Picking that next huge winner. But what if I told you the real secret to long-term success isn't about what you buy, but about what you manage not to lose? So today, we're going to dive into one of the most powerful tools for protecting your portfolio, the stop-loss order. Oh, man, we have all felt that knot that just forms in your stomach when a stock you absolutely love starts to tank. Do you sell? Do you lock in that loss? Or do you just hang on and hope for the best? That fear, it can lead to some really disastrous decisions. But what if you could take that emotion completely out of the game? And this right here points to a fundamental flaw in how we're wired as investors. It's a real thing. It's called the disposition effect. We have this tendency to cling to our losers, just hoping they'll turn around, while we sell our winners way too early, terrified our luck is going to run out. It is the core psychological trap that stop-loss orders are literally designed to help you dismantle.
All right, so here's our game plan for today. First, we're going to break down that emotional trap that trips up so many of us. Then, we'll introduce the automatic safety switch that can protect you. After that, we'll upgrade your toolkit with some more advanced strategies, show you exactly how to set your stops, and finally, we'll cover the really important risks and common pitfalls to watch out for.
Look, it really all comes down to this: our own psychology. The super powerful forces of fear, greed, and hope, well, they're often our own worst enemies when it comes to making smart, rational decisions, especially in the heat of the moment. We need a system, not just our gut instincts.
And that system is the stop-loss order. The best way to think about it is like an insurance policy for your stocks. Or maybe like a full-time assistant who's watching your portfolio 24/7. It's a preset instruction you give your broker to sell a stock automatically if it drops to a price you've decided on. And here's the key. You make that logical decision to sell when you're calm and clear-headed, not when the market is in a total panic.
And how it works is incredibly simple. Let's just walk through it. Say you buy a stock at $100. You decide right then and there that you are only willing to risk a 10% loss on this position. So you place a stop-loss order at $90. If that stock price ever touches or dips below 90, your broker's system automatically, without you doing a thing, triggers an order to sell your shares. It gets you out before that loss has a chance to get any bigger.
And the benefits here are huge. First off, it's cost-effective. Most of the time, it's totally free to set up one of these orders. But most importantly, it forces emotional discipline. You're taking hope out of the equation and replacing it with a solid plan. It's also super convenient, acting like your own personal watchdog. And you can customize your risk for every single stock in your portfolio.
Okay, so you've got the basic stop-loss down. Awesome. But guess what? That's just level 1. Now it's time to upgrade your toolkit because there are even more sophisticated ways to protect your portfolio and, just as importantly, lock in those gains.
Now, this is a really crucial distinction to understand. A standard stop-loss guarantees you'll get out of the trade, but, and this is a big but, it doesn't guarantee the price. It just becomes a sell at the very next available price order. A stop-limit order, on the other hand, gives you more control. It becomes an order to sell only at the limit price you specified, or better. So what's the trade-off? Well, it guarantees your price, but it doesn't guarantee the sale will actually happen, especially if the stock price gaps down and just jumps right over your limit price. Now this might be my personal favorite because it helps solve that other massive investor problem, selling your winners too early. A trailing stop is this dynamic tool that actually follows your stock's price up. So let's say you set a 10% trailing stop. If your stock climbs from $100 to $120, your stop price automatically moves up with it, from $90 to $108. It's just a fantastic way to let your winners run while systematically locking in your profits as you go. And the toolkit gets even bigger. You've got take-profit orders, which are kind of the opposite of a stop-loss. They sell when a stock hits your profit target. There are buy-stop orders that can help you jump into a trade just as a stock is gaining momentum. And then there's the bracket order, which is the whole shebang. It combines your entry, a stop-loss, and a take-profit, basically automating your entire trade plan from start to finish. So we know what all these tools are, but here's the million-dollar question, right? Where do you actually place your stop? Let's get out of the theory now and into how you can actually apply this in the real world. Well, the good news is it's not just random guesswork. Investors usually use one of 3 main methods. You have technical analysts who look for natural floor levels on a chart. Then you have fundamental analysts who might set a stop based on what they've calculated as a company's fair value. And a third, really popular method is to base it on the stock's typical price swings, its volatility, to make sure you're giving it enough room to breathe. And this is absolutely critical. Your strategy has to match the stock's personality. A stable, boring value stock might only need a tight 5 or 6% stop. But a high-flying, volatile growth stock, it needs a lot more room. We're talking maybe 12 to 15%. Trust me, using a one-size-fits-all approach here is just a recipe for getting stopped out of good positions for no reason.
And you know what the best part is? Putting this into practice is ridiculously simple. On pretty much any brokerage platform out there, it's just a few clicks. You select the order type, you punch in your price or percentage, set how long you want the order to last, like good till canceled, and confirm. That's it. You've just built a powerful safety net in like under a minute.
All right, but let's be real. No tool is perfect. And to use stop losses effectively, you absolutely have to understand their limitations and the common, all-too-human mistakes investors make when they use them.
And this is probably the single biggest frustration with stop losses. It's getting shaken out of a good stock by some temporary volatility. A stock can have a sudden, sharp dip. Sometimes it's a dead cat bounce, which is just a brief, fake recovery that triggers your sell order, only for the price to immediately rocket back up without you on board. It's maddening.
And here's the other critical risk you have to get your head around. Your stop price is a trigger. It is not a guaranteed sale price. In a chaotic, fast-falling market, the next available price to sell might be way lower than your stop. That difference is called slippage, and it can definitely happen during big market crashes or overnight news that causes a stock to gap down.
So let's talk about the classic behavioral traps. Number 1, setting a stop based on how much you're willing to lose instead of the stock's actual normal movement. Second, and this is the cardinal sin, is moving your stop loss lower as the price falls. That's just you letting hope completely take over your plan. And third is failing to adapt. Your strategy has to breathe with the market. You need wider stops in volatile times and tighter ones when things are calm. So when you boil it all down, what's the ultimate takeaway here? It's really not just about a trading tool. It's about shifting your entire mindset. It's about becoming a more disciplined, more systematic investor. This quote just nails it, doesn't it? A stop loss isn't about trying to predict the market. It's about accepting that you can't predict the market and having a predetermined, logical plan in place for when things inevitably go wrong. It's your safety switch. It's your protection against a catastrophic loss.
And that really just leaves us with one final question for you. Take an honest look at your own portfolio right now. Do you have a clear, predefined exit plan for every single position you hold? Or, let's be honest, are you just hoping for the best? The choice, as always, is yours.